This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, what we've seen so far in terms of the calculation of our tax liability, or indeed tax payable, on the taxable income figure that we have computed, is that savings income is very straightforward. That again, it's basic, it's higher, its additional rate is 20%, 40%, 45% across the board. There's no variations on that. But savings income is a whole lot trickier. There's a number of variables. Firstly, with savings income, we need to know, do we have any of that 0% starting rate band available to us? That, as we know, is only available to you if your taxable non-savings income does not exceed 5,000. Now, frequently, and probably usually in questions, we'll see that the taxable amount of non-savings income will be in excess of 5,000. And that therefore means that none of the 0% starting rate band would be available. But we've had questions where we've created, as an objective testing question could well do, a figure of taxable non-savings income less than 5,000, meaning that some, probably not all, of the 5,000 starting rate band is available to you. So that was job one. Do we have any 0% starting rate band? Once that had been sorted out, we then had to turn our attention to the savings income nil rate band. Now again, it sounds odd. We've had a 0%, that's nil, 0% starting rate, and we've then got this savings income nil rate band, also as 0%. But the nil rate band has an entirely different set of criteria. It will be available at either £1,000 if the taxpayer is a basic rate taxpayer. It will be available at £500 if the taxpayer is a higher rate taxpayer, and won't be available at all. There'll be no such nil rate band if the taxpayer is an additional rate taxpayer. And we know by reference to our basic rate band limit and higher rate band limit, £32,000 and £150,000 respectively, we know how to determine whether or not the taxpayer is merely a basic rate or higher, or even indeed an additional rate taxpayer. We now come to turn our attention here to our dividend income. Now again, here things have changed. Now you do not need to know what the old system was. Those of you who have done this before, prior to June of 2017, may be familiar with the old system, and you'll see that now this has changed. It has, in the most part, been simplified. Doesn't matter what the old system was, all you need to know is what the new system is. Now, again, we have here what we'll refer to as a dividend income nil rate band. But this time, the dividend income nil rate band will be a standard £5,000 and will apply across the board, i.e., irrespective of whether the taxpayer is just a basic rate or a higher rate or up to additional rate taxpayer, doesn't matter. The £5,000 dividend income nil rate band will apply. There'll be 0% on the first £5,000 worth of your taxable dividend income. After that, well then, we've got an entirely new set of tax rates with which to deal. Again, not a problem because these rates are all provided to you in your tax rates and allowances pages that you have available to you in the exam room. So it doesn't have to be learned, but again, I think by the time you come to that, you should at least have done so many examples that you'll be familiar with these rates anyway. But what have we got here in terms now of these notes? Looking at, again, your OT course notes, continuing on from where we were on savings, as we've just seen, to dividend. So after we've taxed, firstly the non-savings, then the savings income, we then turn our attention to the taxable dividend income. Now, it will also benefit from this dividend nil rate band, a 0% rate on the first £5,000 of dividend income received, but is available irrespective of whether dividends fall within basic, higher or additional rate bands. So we get this on the first 5,000, whatever. That's a whole lot easier to deal with than the problems we had applying the 0% starting rate and the savings income nil rate band when looking at savings income. This is a whole lot simpler. Whatever level the dividend income falls into, basic, higher or additional rate, always the first 5,000 is at nil. Above that, if we have more than £5,000 of dividend income, there will be tax to pay. And that then depends on where those dividends fall. If they should fall within the basic rate band, it's a mere 7.5% tax rate that is then applicable. But go up into the higher rate band, and the numbers get rather more serious. 32.5% will then apply. Go further up into the additional rate band, and then we're talking about 38.1%. Now, as we've said, that dividend nil rate band will apply irrespective of whatever level of taxable income we have. But in determining the tax bands available to each source of income, the dividend nil rate band does count towards the basic rate and higher rate thresholds. We make the point here that the tax in the additional rate band may look like very strange numbers, 7.5, 32.5, but especially that 38.1. Not that you need to know it, but what it stems from is an effective tax increase from previous years, which impacts mostly on owner-managers of owner-managed companies. The effect is that tax rates have gone up by 7.5% as compared to what they effectively were under the old system. Now again, you don't have to know that, but again, when you look at these things, you probably would, why on earth would anybody choose a 38.1% tax rate? It's to create a uniform increase across the different rate bands as compared with what the system was that went before this, up to and including 15/16. We do not need to know, we do not have to know, we won't know what that old system was, it won't be tested. All we've got to do is to apply this new system. And that should be straightforward enough. So let's have a little example, therefore, to illustrate now the application, not just of this, the dividend income bands, but of course on non-savings and savings that precede this. So we have, if you get pen and paper ready, we have set up for you here a little example that will test out the taxability of all three types of taxable income in one example. Now again, I'm starting off with the given figures of net income. You indeed may have to determine what those figures are. What income is non-savings, is savings, is dividend. And by now, we should know that. Dividend income, obviously dividends there. Your savings income, obviously interest income. And non-savings, everything else. What will that include? Earned income in the form of trading profit for the unincorporated trader, employment income for the employee. So we've dealt with both self-employed and employed there. Plus property income. If you're fortunate enough to have a spare property for which you can rent out, then property income is non-savings as well. So we've allocated to the relevant columns and included in our total. Here we've got £36,000 worth of non-savings income, £3,000 of savings and £11,000 of dividend income. At £50,000 there total, we now deduct our available personal allowance, £11,000. Where does it come off? Firstly, from non-savings, leaving us with £25,000 worth of taxable non-savings income, and thereafter to tax £3,000 and £11,000 of savings and dividend income respectively, meaning that the total taxable income, again cross-cast, 25 plus 3 plus 11 is 39, cast down 50 minus 11 is 39, so we know we've got the correct numbers in there. Now then, what do those numbers tell you? It tells you that at 39,000 on your total taxable income there, that the taxpayer is a higher rate taxpayer. Also, the fact that this non-savings taxable income here is 25,000, it tells you that when you come to tax the savings income, there will be no starting rate. There'll be no 0% starting rate band available to you. Again, the non-savings taxable income exceeds 5,000, so there's no 0% starting rate. There is, of course, some nil rate band for the savings income to enjoy. What's that based on? Are you basic or are you higher rate taxpayer? We've already said that 39,000 makes us a higher rate taxpayer, and therefore £500 will be the savings income nil rate band. Okay, let's therefore now attempt to calculate the tax upon that taxable income. Now that is something that you should be able to deal with to begin with in relation to non-savings and then savings income. So I'd like you to pause this at this particular point in time, show your calculations of tax on your non-savings and savings, have a think about how you think we will then tax that dividend income, given what we have said so far, and we'll take it from there. Okay, let's see how we go about calculating our tax on our taxable income. As we said, firstly dealing with the non-savings and the savings income, and then progressing to pastures new and dealing with that dividend income. So non-savings, let's get the pen on this one, non-savings income to begin with. We've got £25,000 worth, as we see, of taxable non-savings income. All of that, therefore, within the basic rate band limit of 32,000. So all of the £25,000 will be taxed at 20%, and that, therefore, will give us £5,000 worth of tax. Non-savings, all in basic rate band, all taxed at 20%. We then move on to our savings income. Remember what we look for first. Do we have any of the 0% starting rate band available to us? Answer that, no. As your non-savings taxable income, as we've just written in there, is 25,000, that exceeds 5,000, so there's no 0% starting rate band available. What there is, because our taxpayer is a higher rate taxpayer, is a savings income nil rate band, but a reduced figure, as is a higher rate taxpayer, of £500 as compared to the £1,000 that would be available to a basic rate taxpayer, of course. So 500 savings income nil rate band, so at 0%, therefore 0. So we've dealt with our non-savings income. We've now started to deal with the savings income. The first 500 of the £3,000 enjoys the use of the savings income nil rate band available, as we've said, to this higher rate taxpayer. That means that the remaining 2,500 all fall still within the remaining basic rate band limit. We've had 25,000 plus 500 is 25,500. If I add 2,500, the remaining 2,500 of the 3,000 to be taxed, that would take us up to 28,000. 25,000 plus 3,000, there's £28,000. So all of that 2.5 is in the basic rate band. So it therefore will be taxed at 20%. And that, what's that going to be, is I think £500 that will then give. So our non-savings, savings income dealt with as we have seen previously. Now, the new bit, of course, how do we then deal with the dividend income? Now, if we just go back to our notes on Chapter 2, what we've seen is that we've got firstly the 5,000 dividend income nil rate band, but then that note there that dividend income nil rate band, the 5,000, counts towards the basic rate and higher rate thresholds. That's the basic rate and higher rate band limits, we should say there rather. Now, those basic rate and higher rate band limits. What we've seen is that in our example, if I take you back to that, master of modern technology, the first £5,000, irrespective of whether you're basic, higher or additional rate, always the first £5,000 is at 0%. It enjoys the dividend income nil rate band, so no tax. Now, what level, therefore, of tax rate is now applicable to the remaining? We had 11,000, we dealt with the first 5,000, the remaining 6,000. Well, again, remember, we've calculated the tax on 25, non-savings, £3,000 savings, that was 28,000 in total. We've now added into that 5,000, 5 on to 28 takes us up to £33,000. 33 is above 32, we're now into the higher rate band. That 5,000 dividend income nil rate band counts towards the higher rate threshold, i.e. the basic rate band limit. It counts towards that basic rate band limit. So, total of that is above 32, so the remaining £6,000 worth of taxable dividend income all falls within the higher rate band, and the higher rate band rate, as we've just seen and will be provided with in the exam, is 32.5%. Now, you're going to have to work that out on the calculator. 6,000 at 32.5%. In it will go, and you will have your income tax liability duly computed. So go back through that. Again, as ever on any income tax computation, analyse each type of income, the taxable income, and put it to its relevant column. That will mean, therefore, that you'll be able to establish net income, as we've done there, made up of your non-savings, your savings, your dividend income, deriving total. Take away your personal allowance, again in order, non-savings before savings before dividend income. Get your taxable income. How do we then tax that taxable income? We tax it firstly non-savings, followed by savings, followed by dividend income. Non-savings is easy enough, up to 32 basic rate, over 32,000 of taxable income higher rate, over £150,000 worth of taxable non-savings income additional rate. Here 25,000 less than 32, all in the basic rate band, so it's taxed at 20%. On to savings income, as we said, no starting rate band available, because the taxable non-savings income at 25 exceeds 5. But we do get the nil rate band for savings income, £500, based on the fact that, and we put notes to this if it was a Section C question, the fact that the taxpayer is a higher rate taxpayer. 2,500, the remaining part of your taxable savings income, that balance falls within the basic rate band, so it's taxed at 20%. We now deal with the dividend income, the final £11,000 to be taxed, and irrespective of whether now you are in a basic or higher or additional rate, the first £5,000, as we see here, is taxed at the dividend income nil rate band. That leaves 6,000, the top 6,000 out of the £39,000 of taxable income. Very clearly, therefore, that top 6, it's out of the basic rate band, it's up into higher rate band, and the 6,000, therefore, is taxed at 32.5%. Whatever that figure, add it to the 5,500 that we've got going there, and that will give you your income tax liability. Look at the basis of how we assemble the calculation of net income, move to taxable income, and then tax that taxable income in order, non-savings, savings, and then dividend income figures. Okay, what I need you to do now, therefore, is to go back to the notes. And there, hopefully at this point, we've already done examples 2, 3, 4, and indeed 5. And that leaves you now to have a go at example 6 and example 7. and to then review through the example answers there that are available to you, and hopefully ensure that you are then okay with the basis of these calculations. Again, should on any of these areas you have any queries, any questions, then by all means send a little question through to Ask the Tutor on your F6 paper, and I'll be happy to endeavour to reply. Okay, so we'll pause this now while you attempt those questions, then come back and we'll finish off this particular session. Okay, well, hopefully, therefore, we were able to deal with those two examples, 6 and 7, and you've checked out the answers and all is well. Again, any problems, as I say, contact me on Ask the Tutor. Finally, in this particular session anyway, but still lots to do on this particular chapter, it's a big old chapter, is chapter 2, we've got what is not a new piece of legislation, but a new inclusion within the F6 syllabus. We've had the legislation for a long, long time, but they have decided at this point in their infinite wisdom now to bring this into the F6 paper. It's something referred to as the Accrued Income Scheme, and it deals with principally government securities, but also corporate loan stock defined as qualifying corporate bonds, which, when we look at it, we haven't dealt with it yet, I know, but when in chapter 12 we deal with capital gains tax, you will learn that the disposal of government securities, gilt-edged securities, and that's the main one that we're going to see, but also it would apply to qualifying corporate bonds, corporate loan stock, that those disposals are exempt from capital gains tax when sold. So we can sell, therefore, such bonds, such securities, free of any capital gains tax. Now that presents, and has presented until this rule came through on accrued income, an opportunity for taxpayers to avoid income tax on the interest income. Because what would it mean? It would mean that without, we're yet to see what it is, the accrued income scheme, a taxpayer would be able to avoid income tax on interest income if the securities were sold just prior to the interest becoming payable. So that if, therefore, just before, weeks, month before, the interest income was to become payable, if you were to sell that on the open market, any buyer would know that in a week's time, in a month's time, whenever it might be, the interest on that security would become payable. And that would be either a full year's worth of interest or half year's worth of interest, whatever there. And for the fact that you've only owned for a month, as it were, you'd be able to get that income. Clearly the vendor knows that, and on that basis includes that accrued interest in the valuation of that security. So when the individual buys it, they buy it knowing that they're going to get that interest income in. For the vendor, making a sale is an exempt capital disposal. The capital gain is not going to be chargeable. So what we'd have been able to do, and what we put in here, is the taxpayer selling would effectively be able to convert what would have been taxable income. So if we had received the interest income, the income would have been taxable, and effectively converted into an exempt gain. Because you then sold prior to receipt of the interest would have been taxable. You've sold it just prior to that and created a bigger chargeable gain because the value is enhanced on the security by the amount of accrued interest at that date. So you've effectively converted what would have been taxable income into a non-taxable gain because the disposal of such investments was exempt and is exempt CGT. Well, HMRC were wise to that particular rules there and therefore gave us the accrued income scheme. How does that work? Right, our little example. On the 1st of July 16, taxpayer purchased £120,000 worth of a government stock, 2.5% exchequer stock, government security. Bought it at a cost of £125,000. Yeah, the market value of a security, an interest-bearing security, may either, as here, be greater than or less than the nominal value. That will depend upon what interest rates are available in the market as compared to the interest rate on this particular security. Now, you don't have to validate why that market value is other than the nominal value. All you've got to do is deal with it. Right. So we therefore had a cost of £125,000 on £120,000 nominal value at 2.5% government here Exchequer stock. Interest was payable on the stock on the nominal value, that's on the £120,000, at the 30th of June and 31st of December. Now, you bought on the 1st of July, the taxpayer bought on the 1st of July, so there was no accrued interest in terms of the costs that they incurred, the purchase price that they paid. But what now happens? On the 1st of December 16, so before the 31st of December 16 interest payment, the taxpayer sold the stock for £127,000, including, as it would, the accrued interest. Now, the difference between what you sold it for, your proceeds and your cost, is not going to go into a capital gains tax calculation because that is an exempt disposal for capital gains purposes. So what would happen is that the accrued interest from 1st of July through to 1st of December when sold, instead of receiving that income a month later at the end of December and being taxed on that taxable interest income, we've managed to include it within the value, the sales proceeds for which we've sold that security and converted what would have been taxable income into an exempt gain. Ain't going to work because of this accrued income scheme. So what now happens? As we've said, the disposal exempt from CGT, but under the accrued income scheme, the following amount will be treated as income and included in the 2016-17 income tax computation of the taxpayer. Why 16-17? The disposal 1st of December 16 there, that falls in the 16-17 year. We had bought it on the 1st of July 16. All of this accrued interest relates to the 16-17 tax year. How much is that income? The interest was on the nominal value of £120,000 at 2.5%, and you bought it on the 1st of July and you sold it on the 1st of December. There are therefore 5 months worth of accrued interest. Now, again, please check but that's where your calculator and check my maths on that. But I made that accrued interest of £1,250. What will now happen is that the seller of that security will have an income tax assessment equal to £1,250, the amount of the accrued income inherent within the proceeds of £127,000 for which they sold the security. No CGT, exempt disposal for capital gains purposes, but the accrued interest, that within those proceeds, broken out, here £1,250, assessed on the taxpayer, the vendor, there in 1617. How do we deal with the purchaser? Because the purchaser, at the 31st of December, 1 month later, is going to receive interest of, well, their half a year's worth of interest, which will be what, £1,500. We'll receive 1,500, 120,000, should be an extra note there, at 2.5%, 6 months worth thereof, that I think is £1,500. Receive 1,500, and that will be on the 31st December 16. But of course, they're not going to be assessed on that full 1,500, but will be assessed on only 250, i.e., take out 1,250 from the 1,500 because £1,500 worth of that has already been dealt with within the tax system, treated as being taxable income of the vendor, the seller of that security. That therefore the accrued income makes sense. And again, what you have there is a bit of legislation that was introduced as a response to what taxpayers were doing there. They were offloading those bonds, those securities, prior to the interest income being payable. That increased the value of the stock they were selling. that created a bigger exempt gain. They converted what was otherwise taxable income into a non-taxable gain. Hence, that legislation was brought in to stop it. And that's the way in which the scheme works. Okay. It is new. Again, anything that's new, as we'll keep on saying, anything is new is likely to come up in the next round of exams. It won't come up in every exam, but in one or more of the exams from June 17 onwards through to March 18, when the legislation continues to be relevant until, I'd expect to see one of the Section A questions involving the accrued income scheme. Okay, that therefore will complete this particular session. Again, make sure, go back, recap over what we've done before we see you again in our next session on this very extensive chapter.